If a full-scale trade war reignites between the U.S. and China, with both countries aggressively raising tariffs, the impact could ripple across the entire global economy. Here's a breakdown of what could happen. 1. Global economic slowdown. A. Trade war between the world's two largest economies would likely reduce global GDP growth. Countries that depend on exports or supply chain integration could suffer economic setbacks. Emerging markets might see reduced investment and capital outflows. 2. Disrupted global supply chains. Industries like electronics, automotive, and consumer goods rely heavily on parts from both nations. Manufacturing costs would rise, and delays could impact production worldwide. Companies might relocate operations to avoid tariffs, but this takes time and increases expenses. 3. Rising prices and inflation. Higher tariffs mean imported goods become more expensive. Consumers in both countries would feel the pinch. Everything from smartphones to clothing could get pricier. This could fuel inflation, forcing central banks to raise interest rates faster. 4. Stock market volatility. Markets dislike uncertainty. Trade tensions often lead to save-offs, inequities strengthening of safe haven assets like gold or the U.S. dollar. Reduced investor confidence in global trade growth. 5. Job losses and business closures. Tariffs can hurt small and medium-sized businesses, especially importers and exporters. Jobs in manufacturing, retail, and logistics are especially vulnerable. Businesses facing rising costs may lay off workers or shut down. 6. Political ramifications. Trade wars can fuel nationalism and reduce diplomatic cooperation on other fronts. It may embolden other countries to adopt protectionist policies, weakening multilateral trade agreements like the WTO or RCEP. 7. Technological decoupling. The U.S. and China could intensify restrictions on technology transfers and investment. Companies might be forced to choose sides, fragmenting the tech world into aligned and China-aligned ecosystems. 8. Consumer behavior shifts as prices rise and availability drops. Consumers may buy less or switch to local brands, delay big purchases like electronics or appliances, demand policy changes or subsidies. 9. Opportunities for third countries. Countries like Vietnam, India, Mexico, and Indonesia could benefit from manufacturing relocations. Global firms might shift production to these regions to avoid tariffs, but these shifts are gradual and may take years to fully materialize. In summary, a prolonged U.S. China tariff war would likely cause global trade to contract, inflation to rise, business uncertainty to grow, political tensions to escalate, economies to become more fragmented. It's a lose-lose scenario in the short term, although it may push some nations to strengthen domestic production and diversify supply chains in the long term.